multifamily in general is, and we've talked about this in the past, in my opinion, multifamily is probably the most active space in commercial financing today.
Right.
It also tends to be the most competitive space, and so we are constantly looking for how can we be the most competitive and offer the most competitive program in anything that we do. But when it comes to multifamily, there's so much potential volume out there. If you can find something that's competitive, you're going to win. And so this particular multifamily program that we're going to talk about today, one aspect of it is brand new. It was just introduced on Friday. There's two parts to this.
Wait a minute. Before you do that, let's make that a cliffhanger, because
I was.
Okay. Oh, okay.
I won't go any further on that. To say this, this program it's I think going to be the most competitive loan multifamily program you'll find. There's only one other that rivals it, and we have access to that one as well. But there's a big negative to that other program, and I'm speaking of the HUD program, in that it takes between 9 to 12 months to close loans, and most people don't have that kind of time to wait. So this is comparable in that in that realm, but closings are much faster, and we've got some other elements here that we'll go into that make this so attractive. So
yeah, and that's huge. So basically, this could be a lot faster than a HUD loan, and has a lot of other advantages too in many cases. So let's get right to what people really want to know, which is, hey, how much does the money cost? That's kind of interesting. Lowest rate multifamily loan in the nation.
Yep. I think I think we're safe to say that. And we'll I'll just review a couple of basics here on what it is and who would qualify and that kind of thing. It's for, you can use this program for either purchase or for refinance, or for that matter a cash out refinance. The parameters here, as you'll see, are $750 minimum loan amount, and for this particular program it goes up to $5 million. We can, of course, do them higher than 5 on a case-by-case basis, but for the most part, we're looking at $750 to $5 million in this particular program. And we can do all classes of properties, A, B, and C. Really, the only stipulation there is that if it's a C-type property, and a C-type property would be kind of an older property, with not that many amenities, that kind of a thing, that property, we'd want it to be in relatively good condition, not need a lot of repairs, not need a new roof or that kind of thing. Right. But just know here that you're not restricted by this is only for A-class properties or anything like that. You can use it for any class.
Now, the loan to values are really interesting on this.
Yeah, 80% loan to value, and that's for purchase, refinance, or even cash out refinance. We can do this anywhere in the United States. We're not restricted by any kind of geographical location. Really, the only restrictions are, as you see there, depending upon the state. Michigan, Ohio, and Nevada, they're still down in that 60% range. And that's just because of the economies, I believe, in those states. And then, of course, my favorite state, Florida, is restricted to 65% still. So anywhere other than those four, we're at 80%.
And even for a cash-out refi?
Even for a cash-out refi.
Okay. That's really interesting. It's getting more and more interesting here.
Yes. So we have the two platforms, the fixed rates, and then we have the adjustable rate on this platform, and that's the one that did come out on Friday. We'll get into that one, but the pricing on that one it just blows me away. This is a Fannie Mae-based product, so we're not, like we mentioned, HUD. We're not a HUD loan here. It's a Fannie product, and the reason we're able to get such good rates on this program is because we have an arrangement with our funding partner that we get wholesale pricing. There is no markup here on the pricing. So really, I think if we go up against anyone else out there, we're going to be able to beat them price-wise, and that is, again, this is a very competitive space. Multifamily borrowers tend to shop their deals probably more than anyone else, because we kind of, if we face the facts here, there are a lot of lenders out there that offer multifamily financing. So that's why I'm so excited about this particular program, because I think we really have something that beats everybody else out there. I really believe that. So again, we're wholesale. There's no markup here. They charge a little origination, and that's what they're looking. That's how they're earning their money on this.
Wow. Okay. Okay, that's really good to know. So fixed rates or adjustable rates, they can go either way.
That's correct. Yep.
So let's look at a little more detail on this. Let's say on the fixed rate program.
Yep, their fixed rate program pricing is based off the 10-year Treasury index. Today, that rate was 3%, or that index. You can get 5, 7, or 10-year terms. 5 would be your best pricing. So the longer the term, you're going to have a slight increase in the rate there. So 5-year term is going to be the best pricing. 30-year amortization. And most of the time we're going to be competing with a bank loan that they're probably refinancing out of if it's a refi. You'll remember that a lot of those loans, most of those loans are maxed out at a 20. Some of them stretch out to a 25-year amortization. But when you have a 30-year amortization, it really goes to the bottom line and increases their cash flow typically. So that 30-year am is a real important factor here.
And let me just explain again why that is the case. And that is really simple, because of all of the, let's say all the rents come in, the biggest expense for the owner is going to be the loan payment, the mortgage payment. So if we can get a 30-year amortization, we're going to get a lower payment, and there's going to be more money that they can take home. And most importantly, at the early stages, they'll qualify more readily, more easily for a 30-year amortization because their cash flow is going to be better. They don't need to have quite as high gross rents, and the expense is going to be a bit higher, and still get the deal done.
Exactly. So all we're doing is stretching the length of time. Even if the rate was the same, if you went from a 20 to a 30, the difference in the actual payment would be substantial. And that is why this is so attractive. And you're absolutely right. It could make the difference between a loan qualifying or not qualifying sometimes. Whether it was a 20-year amortization or a 30-year amortization. So it really helps them, and borrowers understand that typically. They get that, and the longer the term of payback is typically not an issue for them. They don't mind that as long as they can increase their bottom line.
Yeah, it's usually
so just wanted to give you a couple of these rates. These are obviously subject to change, but these were the rates that were quoted today on this program. And this is the fixed rate program. So on the 5-year fixed, and we've gone through, there's different loan to values here. The lower the loan to value, the better the rate, as you'll see. At 75% loan to value, we're at 4.72%.
That's great.
Yep.